Capital markets. We're going to outline who the players are in corporate finance, in the capital markets particularly. On the one side of this diagram, we're going to start with corporates. Corporates are operating businesses. They run manufacturing companies, service companies, technology companies, and they require capital to grow and run their operations. On the other side, we have institutions. These consist of fund managers. They could be institutional investors, but also retail investors as well. These are the people that have capital. So the capital flows from the institutions or investment managers who have the money to the corporations that need that money to grow and run their business. In exchange, the corporations issue back to the investors bonds, which is debt, or shares, which are equity. And this completes the cycle between the two. Now, in the middle of these two groups sit the investment banks. They're often referred to as the sell side, and they have contacts on both sides of this diagram. They have corporate clients and they have institutional investor clients. Their job is to match up the institutional investors with the corporates based on risk and return expectations and investment style to get a deal done. In addition, you have public accounting firms, which will be the fourth category that we talk about in our course. So to review, the four players in corporate finance from our perspective are: number one, the corporates; number two, the institutions; number three, the investment banks; and number four, the public accounting firms. This is an example of how the primary markets work. Let's move on now to talk about the secondary market. In the secondary market, after securities have already been issued, they trade between investors. So on one side, you have a fund manager who wants to buy securities of a public company. On the other side, you have a different fund manager, somewhere else in the world perhaps, who wants to sell those same securities. That trade is facilitated over a stock exchange, but investment bankers get between these clients to help facilitate the trade. So once again, the investment banks facilitate sales and trading and provide equity research coverage to help the fund managers make decisions about buying and selling those securities. This is how the secondary market works. So to recap, in the primary markets, we have banks, corporates, fund managers, and accounting firms all facilitating the issuance of securities. And then in the secondary markets here, we have fund managers and banks working together to trade in the secondary market. This is what makes markets liquid. This is what allows you to get in and out of a security very easily, is this secondary market trading.